value investor. The value investor searches for good businesses that the market may be undervaluing. The key question is whether the business is worth more than the market says. To answer that question, the investor studies what the company actually owns and earns. Assets matter, but so do debt and other obligations. When a strong business sells for much less than its estimated value, the investor may see a bargain. The opportunity often appears where the crowd is looking somewhere else. But the market may take a long time to recognize what he sees. If the business improves, the market can eventually catch up. Value investing is built around research, discipline, patience, and buying at a discount. The growth investor. The growth investor is looking somewhere very different. The focus is not what the company is today, but what it could become. Growth investors want businesses whose revenue and customers are expanding quickly. A tiny company can become interesting when the market around it is enormous. The investment is a bet that the company can scale rapidly. When the prediction is correct, the returns can become enormous. But not every promising company succeeds. A company can grow and still be a bad investment if investors expect too much. That is why growth investing can produce very large gains and very large losses. Growth investors are betting on tomorrow. The dividend investor. The dividend investor wants something more immediate: cash flow. Dividends are payments made to shareholders from company profits. Dividend investors often prefer established businesses with stable cash flows. The attraction is the repeated income arriving over time. Many investors immediately reinvest those payments. That creates a compounding cycle. Over decades, those payments can become a significant source of wealth. But dividends are not guaranteed. For dividend investors, cash flow can be just as important as price growth. The dividend investor is trying to build a growing income machine. The passive investor. The passive investor chooses simplicity. Instead of selecting one company, they buy a broad collection of businesses. The risk is spread across many holdings. One business can struggle while another succeeds. Many passive investors contribute a fixed amount regularly. Even when markets crash, the strategy is usually to stay invested, because the strategy is designed around the long term. It also requires far less daily decision-making. The system can be remarkably simple. The passive investor is trying to own the market and stay out of its way. Some investors prefer assets they can physically see. The real estate investor. Real estate investors buy land, houses, apartments, and commercial buildings. Those properties can produce monthly rental income. That income can help investors buy additional properties. The investor can potentially earn income while the property itself rises in value. Borrowed money can allow investors to control larger assets. But real estate also comes with vacancies, repairs debt, and falling prices. Owning property means managing everything that happens around it. Real estate wealth comes from owning physical assets and managing them well. Finally, there is the investor who makes one of the riskiest bets, the venture capitalist. Venture capital investors search through young companies looking for exceptional potential. They examine the founders, the product, the market, and the growth potential. In exchange for funding, the investor receives part of the company. The funding helps the company hire people, build products, and expand. The problem is that most startups do not become huge companies, but one extraordinary winner can completely change the result. A small ownership stake can become extremely valuable if the company becomes enormous. These investors are not chasing wealth in the same way. Value, growth, dividends, passive investing, real estate, venture capital, different strategies, different risks. One goal: putting money to work.